We're standing by in the next minute or so the RBA to hand down its latest rate rise. Markets predicting a 0.5% increase. Let's bring in our business editor Ross Greenwood. And Ross, just a few moments away, amid some concerns that another 50 basis points could be a risk and that recession could be a possibility, Ross.
Well, it's true, although I would suggest that probably households and businesses have coped pretty well with these rate rises so far. Remember, it was back in May that the Reserve Bank started raising rates, and that was by when it went from 0.1%. And now if it does raise by 0.5% today, it would take that cash rate to 2.85%. So the impost is enormous. So here it is. They have just announced they will raise the interest rates by 0.25%. So certainly there is no doubt that this is less than the market's anticipated. It shows also that the Reserve Bank is wanting to sit and wait and see the impact. So just to repeat, the Reserve Bank has today, despite the forecast of a 0.5% rate rise, have increased the rates by 0.25% to 2.6%. So the important part about this will be the reasoning for the Reserve Bank doing this. I'll just try and get a few of those reasons as to what the Reserve Bank is saying about its decisions today, and effectively really to see some of the rationale. It says today's further increase in interest rates will help achieve a more sustainable balance of demand and supply in the Australian economy. It's necessary to bring inflation back down. The board expects to increase interest rates further in the period ahead. It's also closely monitoring the global economy, household spending and wage and price setting behaviour. The size and timing of future rate rise increases will continue to be determined by the incoming data and the board's assessment of the outlook for inflation and the labour market. But I think what this really seriously tells you is that the impact of such a significant rate rise over a period of time, and you can see where it is here, there was a forecast. This is what it's actually done, 2.6%. It shows that at least the Reserve Bank is cognizant of the things that were seen in the UK last week, where, of course, tax hikes or tax cuts in that country were potentially going to really spin the wheels of that economy. And the point is, even here in Australia, it's waiting to see the impact of the rate rises so far and the way in which ultimately Australia's economy cools.
I guess, Ross, there is that lag effect, isn't there, with the official cash rate for it to show up in people's mortgages, particularly those who have had fixed rate mortgages, and when they come off, for many households, that challenge looms.
Well, that's true. And do consider that before this rate rise cycle, some very clever people, actually around 40% of people who were taking out home loans were doing so with fixed rate mortgages. And in some cases, they were getting fixed rate mortgages for 3 years in the very low twos. Well, today, those same fixed rate mortgages are close to 6. And so those people will have a significant impact. So you can see here, if you like, the cycle of this interest rate rise, rising, as I said, in May from 0.1% to 0.35%, and then all the way up today to 2.6%. Remember also what the Reserve Bank, Philip Lowe, has indicated here is that the rate rises are not over, that the Reserve Bank is determined to head off the inflation rises in Australia. Inflation, there is evidence that it's starting to cool just a little bit. And so you can see here just the enormous increase in the costs that's taken place. So households themselves have seen significant increases in the amount of money that they're having to spend on mortgages as a result of these rate rises. Say for people, on the best part of $1 million mortgage, it seems like a lot these days. Well, it's more than $18,000 additional that they're paying on what they were paying earlier this year. And that's after tax, remember. So it's a decent chunk out of people's wages. And that's the thing that the Reserve Bank is banking on to try and quell the spending of Australians, which also, therefore, would ease off the inflation rate.
Ross, thanks so much as always.